Thank you all for joining today's Earned Interest training. We appreciate your participation. As mentioned in the email communication, should you be a grantee who was part of the recent Earned Interest audit with the OIG and you found that you had a recommendation or otherwise, we do ask that your participation in this training be noted. And for those of you who are unable to attend, you can view the recording once it's posted to our website and simply send us an email to grants@eac.gov letting us know that you watched it and what your takeaway was from the training. Today, I am joined by my grant specialist colleagues, Tina Bateman and Sammy Cordova. They'll be helping me out in the chat and otherwise as we go along today. There are quite a few slides, so I ask you to bear with us as we go through all the different details around federal earned interest and otherwise, and those details specific to HAVA grants. Again, we appreciate your participation. Please remain on mute. Feel free to put comments or questions in the chat as we go along, and we will be certain to get to them when we open it up for questions at the end. So an overview for today's training. The big question, what is earned interest? What are the federal requirements? What are HAVA's requirements? What are the particulars around depositing and calculating interest? How should you be reporting interest that's earned and expended? And what are some other additional thoughts and theories and tips around earned interest? And as mentioned, we'll open it up for questions and comments at the end. So the big question, what is earned interest? Earned interest represents the dollars that you gain from depositing your federal award into an interest-bearing bank account. And again, a lot of this information is very familiar for all of you, but we want to get into the details and particulars for those of you who are not necessarily as experienced. So it seems pretty straightforward, but not all federal awards are required to be deposited into an interest-bearing account. In particular, HAVA grants are because they are advanced to you. So because you are advanced, meaning you're not reimbursing yourself from the grant, those dollars are required to be in an interest-bearing account. The interest is earned in addition to the grant dollars. So we allow you to earn this interest and spend it on top of the federal dollars you've already received for the award. And then any interest gained from the deposit of the award must be spent on allowable costs for HAVA. So even though you're earning interest off the federal award, we expect that you're going to keep spending those interest dollars on allowable activities under HAVA. What isn't federal interest? There's a couple terminologies and definitions out there we want to be sure that you know is not related to what we're speaking to today. So first and foremost, program income. Program income is the money that you earn from charging fees for services related to the grant. So for some of our grantees, you sell registration lists or you provide other services that you charge a small fee for. That is program income. That is not considered earned interest. Federal interest earned on this award is not avoidable. As mentioned, all advanced federal funds have to be placed into an interest-bearing account, so you can't avoid this particular regulation. And then there's the other definition of federal interest. Federal interest is also described in the 2 CFR, the Uniform Guidance, as the government's share of property, equipment, or supplies purchased with federal funds. Quite literally, what is the government's interest in what activities and purchases that you've made on the award? So a little bit of regulatory explanation for the next few slides. This first one is from the Uniform Guidance, and it's about financial management requirements. So again, most of this is familiar for many of you, but just to go over the base understanding of what the building blocks are to a strong earned interest report is the idea of having strong financial management controls in place. So as 2 CFR 302B describes, this is a system that each non-federal entity has to provide for the following components, which is you should be able to identify each federal award that you receive and you expend on. You should have accurate, current, and complete disclosure of all financial results for each individual federal award. The records should identify the source of funds for each federally funded activity. You should maintain control and accountability for all these funds and related property and assets. You should be able to compare expenditures against the budget for the federal award. And you should have written procedures in place that you implement the requirements of not only 2 CFR 200, but also your internal controls and policies. And lastly, it should all be in accordance with terms and conditions of this particular award. So another uniform guidance piece is the requirements for pass-through entities. And here we're talking about your subcontracts, subrecipients, or subawards. These terminologies are used interchangeably, so for our sake, we're going to talk about subrecipients. So as it says here, all the requirements that the federal agency asks of you at the state level should be imposed through the pass-through entity onto the subrecipient so that the federal award is used in accordance with the federal statutes and the regulations and relevant terms and conditions. So again, just a reminder that if you're passing through money to subrecipients, be mindful that they also have to adhere to all the different terms and conditions and regulations that come with the federal award. In 200-305B8, we're looking to certain exceptions as it comes into play for interest. So some things to consider that may affect those grantees who do pass through funds to subrecipients. In some instances, you may have exceptions where you can say, you know, we're not going to have to be a stickler about you depositing this HAVA award that we're passing through to you into an interest-bearing account. Because per these conditions, if that subrecipient is receiving less than $250,000 in federal awards per year, they wouldn't have to actually do all these particulars for the interest-bearing account and monitoring of the earned interest activity and expenses. So I'll explain that a little better. When you have a subrecipient who cumulatively receives less than $250,000 in federal grant dollars, they do not have to be concerned with tracking earned and expended interest from the federal award. The other exceptions that fall into line here is that sometimes the best or most reasonably available interest-bearing account wouldn't actually earn more than $500 a year on interest, or perhaps it would be cost prohibitive to use a particular banking service to monitor and earn interest on your award. In certain unusual circumstances, a foreign government or banking system may prohibit you from actually participating in this. If you find that you have that particular exception, we would definitely want you to reach out to us and let us know. But this is all of consideration as you pass through money to your local jurisdictions, that even though we're asking you to make sure they follow all the federal rules that you have to follow, if they fall into one of these exceptions, then they don't necessarily have to monitor earned and expended interest on those federal dollars. We can always go over this in more finite detail. You're welcome to reach out to your grant specialist. The regulation at the bottom here, 305B72, just goes over the standards governing how there is use of banks and other institutions for advance payments. So again, it's just reiterating you have to deposit advance federal funds into an insured account wherever possible. So we went over the federal regulations that speak to earned interest and financial management and controls related to that. But there's actually some details in the HAVA Act that speak to interest-bearing accounts. So I wanted to be sure we spoke to those particulars on these slides. So the first part of this is HAVA 104D, which describes the deposit of amounts into a state election fund, as many of you know. When you have established an election fund described in 254B of the HAVA Act, you have to ensure that any funds provided to you through this are then ongoingly deposited into the fund and maintained in such a fund. So most of you know this as your HAVA fund or your election fund, and it's just really, simply put, the bank account that you're putting HAVA funds into continuously. The other part of the HAVA Act that goes into a bit more detail on this is in 254B1D, and you'll see highlighted at the bottom here that it actually calls out the interest earned on deposits of the fund. So again, we spoke to having to deposit HAVA awards into that particular election fund, and now the Act is actually calling out the earned interest and the deposit and the related earned interest being monitored. So just a good reminder that these requirements happen on various levels, and this is why there's such a keen awareness and review of earned interest on HAVA awards. Back in 2005, we did have an EAC advisory where the question was asked, does the state have to remit interest that they earn on Section 101 Title I, which is the original 101 Election Improvement Grant? Do they have to remit those earned interest funds back to the federal government? And back in 2005, we determined no, you may keep any earned interest and spend it on allowable activities. And this advisory goes into more detail about that, but I simply wanted to point out that the discussion about earned interest and the activities on earned interest and its related expenses has been a highlight of the HAVA award for some time. And we, again, want you to earn the interest and use it above and beyond the federal award on allowable activities. We want you to definitely spend this money on helpful tools and resources related to federal elections. And it's pretty unusual that you actually do return interest funds back to the Treasury or back to the EAC, if you will. The few circumstances this happens is where we have a program such as CARES that ended, it both started quickly and ended quickly, and some grantees earned interest they just simply didn't have time to expend. In those particular situations where the grant ended and you didn't have enough time to spend it, you did send it back to us. So I want to point out that caveat, but certainly in general with our open-ended HAVA awards, we want you to earn that interest and spend it on allowable activities. All right, that was a lot of regulation to go over so early in the morning. So we want to take a little break here. Everybody grab a sip of water. Here's a lovely picture of a lake in northern New Mexico. Thank you. And since everybody has covered all the regulations related to HAVA and earned interest, now we're going to move in to the actual nuts and bolts of what it looks like when reporting. So let's start with depositing HAVA funds. So as you know, the EAC, we can't require any specific banking eligibility requirements or banking particulars to you. We are asking that you deposit it into the election fund, that it be with an insured bank, but we can't tell you which bank to use. We can't tell you the particulars around that. And that's usually also something that is provided by your state fiscal offices. So many of you have to abide by those rules anyway. So you must be able to account for the funds received, the funds obligated, and all the funds expended. So remember, as we talk about financial management in general, you got to be able to account for the whole life cycle of this award. And here is something we're going to discuss in detail. One of the particular pieces of language related to earned interest within the regulations in the Uniform Guidance says, entities must minimize the time elapsing between receipt of the advance payment and the transfer of the advance payment into an interest-bearing account. So what does that mean in reality? The EAC defines this as a timely deposit, and we have not had particular specific guidance on this in the past, so we're here today to define it as 90 days. So what does this mean? This means that we are asking, once you receive the HAVA award, from that day of receipt, you have 90 days to get it into the interest-bearing account. And on the next few slides, we're going to go into more details about this. So, as I mentioned, you've got 90 days from the time of receiving the HAVA grant to get it into that interest-bearing account. But if your state is unable to move the dollars from the receiving account into the interest-bearing bank account within 90 days, then you must make a calculation to determine the amount of lost interest from that delay. So again, the calculation of lost interest is going to begin 90 days from the receipt of award until the end date the funds were transferred. And one thing I want to parse out here is that we're giving a 90-day grace period. So before we get to this little quiz below, I want to clarify this one more time. If you are receiving a HAVA award, for instance, on February 1st, and it takes your state fiscal office or your actual elections office several weeks or several months to get it into that HAVA fund, that election fund, we are saying you have a 90-day grace period. If you are unable to deposit the fund within 90 days, then we're asking after 90 days for you to start calculating how much lost interest there would be and restore it back to the fund. So we've got a little quiz here based on this timeline. So with the guidance that is listed on this slide and the information provided, given these dates here of when the HAVA award dollars were received, which is February 1st of 2023, and the date of transfer into the interest-bearing account of August 1st, 2023, what would you expect, or how many months approximately would you expect to have to calculate lost interest against? And you can put your answer in the comments. We'll take a pause and look for those. All right, I see some answers coming in that are pretty consistent here. And that's exactly right, everybody. So there would be 3 months of lost interest based on our guidance. So again, you've got a 90-day grace period, but if it took you 6 months from the time of receipt to the time of transfer, it's going to be an extra 3 months of calculated interest you need to consider and then deposit. So now that you've got that award deposited into that account, now you have to start recording that earned interest. So again, per all the fiscal management guidance, states must maintain records that identify and clarify any accrued interest amounts for the HAVA awards. This is inception through the entire award through closeout. The EAC does require that interest income be reported on the FFR for both your state and your subgrantees. Again, the subgrantees may have that exception that we spoke to earlier, but in general, you have to be considerate of your state match and your subgrantees possibly earning interest and then reporting that on the FFR. And then no matter which state office, meaning internal to your own elections office or external to a fiscal or treasury office, performs these calculations, you as the grantee are responsible for maintaining accurate records related to it. So a good audit tip here regarding records. You really want to keep financial reports and documents that tie to your submitted FFR, and this is absolutely necessary for a successful audit. So your financial reports that you have that reflect that earned and expended interest should identify the same amount that you're putting on those federal financial reports that you're turning into us. When there's adjustments or corrections, you want to be sure that you also add in that explanation and documentation to your backup. So that way there's no question in the future why you put that particular amount on the FFR. So calculating earned interest. So as you know, accrued interest calculates and can be performed in multiple different reasonable ways. Your state financial offices, fiscal, treasury, Department of Accounting, what have you, may have a particular method for calculating and recording interest on behalf of your agency or perhaps all the departments in your state. So again, their methodology that they're beholden to for the entire state or, particular agencies is absolutely considered reasonable and acceptable. And interest rates and calculations are going to vary pretty greatly between states. We're going to have some examples coming up that will help you understand just how nuanced and a little bit different everybody is operating within calculating their interest and recording it. So first and foremost, I want to thank the states who offered up their information on the forthcoming slides here. We've got some helpful examples of states who recently passed the earned interest audit. We wanted to give you some helpful examples of what other grantees are doing that allow them and afford them easy reporting, recording, and review of the earned interest as well as the expended interest. So let's look at Idaho. So their state treasurer's office is calculating the interest for them. And their interest, once calculated, is deposited into their agency fund once a month. Their deposits and expenses are tracked internally using specific expense codes within the financial system. And because they're using that specific coding for interest, when they pull financial reports, they're able to quickly identify and report against interest for the EAC, FFR, and otherwise. With Nebraska, the funds are actually invested daily by their investment council, and all the earnings are allocated, distributed, and recorded monthly. The election staff are able to pull the interest reports from the state's entries, and again, they're using a unique accounting code to do so. Where there's multiple HAVA grants, the elections office actually has a spreadsheet so they can allocate the interest earned against each grant's share of it. So again, they've got multiple open awards and they're calculating based on the earned interest a proportion that is equal and consistent among their open awards. 2 staff members are trained to pull and complete the FFR and understand what it takes to report and record that earned and expended interest. And 1 employee will either enter the data or review it, and they act as a backup for one another. In Nevada, the state manages the bank accounts and calculates interest for all the agencies. The SOS office is reporting quarterly on HAVA fund daily balances, expenditures, and revenue. Their state calculates their share of interest based on a quarterly report. So we've talked about daily, monthly, and now we see an example of quarterly. Once the state finishes their quarterly calculation, they process an accounting entry so they can move the amount of earned interest into the election fund. And then Nevada is posting a copy of that quarterly report so everybody can go and reach it and pull it for their own needs within their own departmental offices. In Texas, again, they've got a state treasury office that's allocating interest each month proportionally to their state code and their internal controls. Allocation is based on a total daily collected cash fund balance minus bank fees. The Treasury's daily fund balance does tie to their general ledger cash reports. So I think this is a key thing to think about as you pull these financial reports. Again, we want to make sure that they're tying out to the real data that you're putting into the FFR. So one thing to pick up on that Texas pointed out is that since they're doing daily computations, sometimes the interest goes down. As we all know, the market goes up, it goes down. Sometimes we see a dip in interest. This is absolutely understandable and acceptable. As I say here, it's totally okay. We often will see this reflected on your FFR. And sometimes we'll shoot you a little message or an email that says, hey, we noticed your earned interest amount dipped down on this quarterly report. Can you confirm that that is appropriate and provide any explanation should you need to do so? So for those of you that have experienced this, you know, oh yeah, we just had a little dip in our earned interest this last quarter, so it went down by X amount of dollars. We see this routinely, so just know that if that's something you happen upon in the future with your FFRs, it's totally okay. Adding a comment in the FFR helps us understand and relieves us from that communication back and forth. Okay, moving on. So all related data is fed into the Texas state accounting system, which the election staff can then pull reports from so they complete their FFR against those. They save all their supporting documents from the accounting system and they link them internally again to a workbook. And this affords them the ability to track and see all of the data in one place. And upon submitting the FFR, their data is made static so they can ensure that for future reference, they know exactly why they entered the data they did into the FFR. So some broader takeaways from these examples. The states have an established method for calculating and recording interest. It's not necessarily a method specific to HAVA, it's a method specific to their state, and that's totally okay. Each step of calculating, reporting, and monitoring earned interest is maintained in records for both internal and external offices, and everybody has access, should they need to review them. A consistent process is kept when calculating and reporting. Having consistency in this process is really key to ensuring that you have successful review of your FFRs as well as successful audits where that occurs. So one more grantee highlight, the Oklahoma State Board of Elections office does work with their state treasurer to calculate interest, which is reported to them on a monthly basis. And they have had this routine long-standing, so it affords them really easy understanding of where the data is at and ease of reporting and successful audit results. So one thing we haven't mentioned here is that all of these examples show these states having external financial offices that support them in recording, maintaining, reporting, calculate all these different aspects of interest, which are really nitty-gritty on some level. We know that we have some grantees who do not have external offices to support them in this endeavor. So we want to recognize those grantees that don't have that support granted to them, and where you find yourself struggling in your efforts to monitor, record, report, and document all of this interest data, we want you to know that it is possible to use your HAVA funds to hire either an outside specialist, consultant, contractor to assist you with establishing a process and a procedure so you can easily report, record, and monitor your earned interest. So should you be a grantee who is struggling, or perhaps not struggling, but really looking for best practices and support in doing this, reach out to us at the EAC and we'll help ensure that you get the assistance you need. All right, so now that we know what the numbers are, now you've got to report it. So as you all know, we have a modified SF-425, which is the federal financial report, to collect the federal interest data as well as the state match data related to interest. So as you can see here, a little screenshot, lines 10P, 10Q, 10R focus on federal interest income as well as the federal interest expended. Interest earned from federal awards have to be spent on allowable activities for HAVA, and purchases from all of that should be reported within this area. I want to honor that in years past, we were using a more general common form version of the SF-425. We, at previous iterations, had guided you to put earned interest amounts into the program income line, comments box. So again, now that we're in the GLASS system and we have this modified SF-425, we want to see your federal interest dollars reported cumulatively in 10P, 10Q. So the state match interest, which we haven't talked about yet. So again, we have this updated FFR and it affords us the clarity to identify interest earned from your state match amount on lines 12A and 12B towards the bottom of the FFR. So this only really affects those grantees who have a cash match. So we are looking for you to deposit your cash match into an interest-bearing account, and any interest that is earned from that match should be reported within 12A, 12B. There are a few exceptions in this regard where maybe there's a rule internal to the state or otherwise that prohibits certain earning of interest on particular cash dollars related to your general revenue. In those particular circumstances, we're aware of them. But in general, we are expecting you to deposit cash match into an interest-bearing account and report on it. So for instance, this would be pretty common for the election security award, the current 101. The 251, the older open award that many of you have, should also have match. So in this regard, you should see cash match interest reported on 12A, 12B. One unique situation in all of this is the original 101 election improvement grant. That original grant did not have a match requirement. There are very particular circumstances where a grantee did provide a match, and it was a cash match, so there may or might have been earned interest and expended interest on that. In those particular finite circumstances, we're looking for you to report the information as full federal expenses in 10G and the particulars in 12A. So, it's one of those finite situations that you're probably already familiar with, but in general, this really only affects those grantees that are using cash match. And again, we want to be sure that even if you're earning interest on a match dollar, that you're spending that on allowable HAVA activities. And we've got a little screenshot here at the bottom of 12A and 12B. All right, so let's complete an FFR together. And for many of you, I understand this is very familiar and routine, but for those of you that perhaps work on a different aspect of HAVA grants, we wanted to show you into the system today to see what it looks like to execute this particular form, especially as it pertains to earned and expended interest. I'm going to share our stage environment with you. And just so you know, again, this is all staged data. This is fake data, and this is a created account with Hayden, Hawaii. So if any of my Hawaii grantees are on today, please know this is all fake data, so please don't worry. But what I've done here is I've logged in and I've pulled up their election security award and drilled down into the GLASS system to pull up the FFR menu. So you can see we've got some open FFRs here. I'm going to go ahead and click on the quarterly report that's available. So for those of you who constantly work in and out of these reports, this should be very familiar. For those of you who do not work in these reports, this is the financial report that we're looking to see cumulative data on through the reporting period. So for instance, we just had a reporting period end as of June 30th. So the most recent report you all turned in would have reflected cumulative expenses through June 30th of 2024. As we open up the report, we're going to see the static information that we want you to update. So I'm going to say the basis of accounting is accrual. On the next screen, this is where the nuts and bolts of what we're speaking to today really come into play. So here we've got, again, just static created data of 8.6 million in cash receipts that would represent the federal award amount. Let's say for today's example that so far through this reporting period, cumulatively $5 million have been spent. So you can see 10C automatically update with the available balance. As many of you know, the rule of thumb for FFRs, 10B must equal 10E for HAVA awards. So we're going to repeat that $5 million. 10F represents outstanding unliquidated obligations. This is basically expenses that have been incurred but not necessarily processed yet. For those of you that have the basis of accounting that reflect this, you know how to report here. I'm going to say for this example's sake that we don't have any unliquidated obligations for this reporting period. So program income, as we described, that is not earned interest, that is not expended interest. I'm going to say for this example's sake, we do not have any to report today. And here is the federal interest box that we've been speaking to. So again, this is a cumulative number. So through the reporting period, let's say $500,000 in federal earned interest was documented and provided by our Treasury office. And then we have another report that shows through the reporting period, we spent approximately $450,000 of that earned interest. And you can see it gives you the nice little warning if you goof your entry. Below here, recipient share simply represents your state match expended. So just to complete this, I'll put that we spent $1 million. So now that we've got our data entered in lines 10A through 10R, let's hit next. This next box is indirect expenses. For those of you who claim indirect expenses, whether it be the de minimis or a negotiated rate, you know how to fill this out. If anyone has any questions, you can email grants@eac.gov with a separate question. We'd be happy to answer. And here we are, as I mentioned earlier, if you're a state that has a cash match that's earning interest, we want to see that reported here. So 12A, let's say for this particular example, we had $50,000 earned. And let's say we know we earned it, but we haven't spent any, so we'll put 0. And again, for this example, we'll say we have no program income. For those of you that have nothing to report in these boxes, you should be able to leave them blank. You shouldn't have error posted in case you put no entry. It can remain 0. Here we allow you to add in additional documentation. If you like, some grantees add their working papers or their backup worksheets to this area. You certainly do not have to. Just so you know, if it's available there, we don't necessarily have to review it, but it's, here should you need to do so. And then again, comments here. Whenever you have a particular deviation, such as you lost interest this particular reporting period, it's super helpful to have a comment here for us. All right, so now that we filled out our report and we don't see any errors over here, it looks like we've got nice check marks allowing us to move forward. Let's just punch in our information. And you can see it's populating for me. It remembers from yesterday. I'm going to click sign. And again, we are in the stage environment. And I'll hit submit. And I'll say yes. And there we are. So again, thank you for allowing us to go through this exercise. Not everyone on this call, I'm sure, is available to create and enter FFRs. So this is just another helpful way to see what that looks like. I'm going to switch back to our presentation now. So a couple helpful bits of information related to what we've spoken to today. Your office might calculate and record interest very differently from another grantee. Even though the processes might look pretty similar from state to state, the actual, nuts and bolts of calculating and recording it could be pretty different. As long as it's consistent, reasonable, we're going to see it as appropriate and allowable. For those states, as we mentioned, some of you are on a quarterly cycle, some of you are on an annual cycle of getting information about your earned interest. So just know that in those instances where you don't have any updated interest data to provide on the FFR, it's okay to report your last known numbers. So again, if you're a state where you only get your earned interest amounts and the related share of interest that you can expend on it once a year, and again, we know for sure we have a couple grantees who are like this, then we just want to see that updated at least on an annual basis. We're looking at your FFRs when we review them to ensure that either that number is staying the same or increasing. So if we don't see it increase over the course of a year or at least a couple quarters, we might send you a message and ask for clarification, but just know it's totally okay to say, we only get our information on interest semi-annually. You'll see it updated on the next report. And then again, just to reiterate, timely and minimal time lapsed. So this idea of what is the amount of minimal time, the EAC is putting forth the guidance that it's 90 days. And just for everyone's understanding, we are actually going to have formal guidance on this posted to our website. We're currently working with our internal teams to do so. We expect all of this information to be formalized on our website next week. So here's a little FAQ, and it is a particular kind of interesting aspect. So some of our states have overmatch. So in this FAQ, if a state maintains a higher level of state share than what's required for the election fund, how much interest should they be reporting? So more specifically, this is a state that has a cash match and they're able to deposit more than what's required for the HAVA fund. So let's say your required cash match is 1 million, but you actually have available to you 1.2 million in cash match, and you're earning interest on it. So for the particular grantees who experience this, it can be really difficult to separate out what the related earned interest is in comparison to 1 million versus 1.2 million. You are more than welcome to always report overmatch and the interest related to that overmatch on your FFR. Just know that when you do so, that dollar amount, those data particulars do get subject to audit. So just remember to maintain all the related documentation to overmatch should you be reporting on it. All right, so a little bit of a quiz here as we wind down with this training. When you're ready, so put it in the comments, your answer. The EAC's recent guidance defines timely deposit of HAVA funds as A, 90 days, B, 3 days, or C, the timeline is determined by your grantee fiscal office. And I appreciate everyone responding in the comments box. I'm seeing consistent A's, of course. I know I've really pushed this idea, but we want you to know that 90 days is the timeline. Thank you, everyone. So here we've got a page for resources. This is just a nice helpful page with all the links to the different pieces that we spoke to today. The one thing you're not seeing here, as I mentioned, is our new page with guidance specific to earned interest. We're going to post this training, the slides, all the relevant information from today's training onto that webpage. We expect it to be up soon, but please know it'll take a minute, and we'll be sure to email the grantees, all of you, to let you know when it's up on the web. So I just want to thank all of you for having the space and patience to learn about earned interest today. I'm going to end the recording in a moment, and I will open all of this up for you to ask any questions or any comments you might have.